Welcome to our CFP Exam Prep podcast. Today we're diving deep into a crucial tax topic that frequently appears on the exam: personal residence gain exclusion. This concept often trips up test takers, but understanding it thoroughly can help you secure those valuable points. Let's break down the fundamental rule. When selling your primary residence, you can exclude up to $250,000 of capital gains if you're single or $500,000 if you're married filing jointly. But here's where candidates often make mistakes. These exclusions aren't automatic. You must meet specific tests to qualify. The first test is the ownership test. You must have owned the home for at least 2 years during the 5-year period ending on the date of sale. The second test is the use test. You must have lived in the home as your main residence for at least 2 years during that same 5-year period. These 2-year periods don't need to be consecutive, but they must total 24 months. Let me walk you through a practical example. Sarah bought a house in 2015 for $300,000. She lived there until 2020 and sold it for $600,000. Her gain is $300,000. Since she's single and met both tests, she can exclude $250,000 of the gain. She'll only pay capital gains tax on the remaining $50,000. Now, here's a common trap question on the exam. Married couples need to be especially careful. For the full $500,000 exclusion, both spouses must meet the use test, but only one needs to meet the ownership test. The exam might present scenarios where one spouse hasn't lived in the home long enough, making the couple eligible for only $250,000 exclusion. Another frequently tested aspect is partial exclusions. If you fail to meet the 2-year requirements due to work relocation, health issues, or unforeseen circumstances, you might still qualify for a partial exclusion. The exam loves to test these exceptions, so remember them. Here's where many test takers stumble. They forget that the exclusion can be used repeatedly, but not more frequently than once every 2 years. Also, the property must be your primary residence. Vacation homes and rental properties don't qualify unless they've been converted to primary residences with proper timing. Let's address basis adjustments, another testing hotspot. Home improvements increase your basis, reducing your taxable gain. However, repairs don't. The exam might try to confuse you by mixing improvements and repairs in a question. Remember, improvements add value to the home, while repairs maintain it. A valuable tip for the exam: when calculating gain, start with the selling price, subtract selling expenses and basis, then apply the exclusion if qualified. Don't make the mistake of applying the exclusion first. Remember these key points: 2 years ownership and use within 5 years of sale, $250,000 single, $500,000 married, filing jointly. Both spouses must meet use test for full married exclusion. Partial exclusions available for specific circumstances. Once every 2 years limitation. Primary residence requirement. Keep practicing questions involving different scenarios and timing issues. The exam typically presents complex situations where you'll need to determine if the exclusion applies and calculate the taxable gain. Focus on understanding the rules rather than memorizing them, as this will help you tackle any variation the exam throws at you.